This week was nothing short of remarkable. Volatility closed with surgical precision. The US dollar continued shaping a technical bottom, and bond markets are inching toward major decisions as the month wraps. Oil is at a critical juncture, with Elliott Waves flashing red. Are bulls even in the game? Natural gas is showing classic signs of launch mode, while gold and silver shocked many, unless you followed investing angles closely. As always, we examine SP 500, Nasdaq, Dow, and Russell through multiple lenses, evaluate SPX sectors, and offer exclusive deep dives into NVIDIA and TSM. Welcome to the Weekly Digest, your edge in the volatile market environment. And we traditionally start with volatility. This is the daily closure on Friday for volatility index for S&P 500 and its futures. What we are seeing here is the technically a bearish candle and a freshly made 8x20 MA bearish cross. So the cross didn't happen for the futures. However, the candle is somewhat neutral right now, and it could be either bearish or bullish depending on the next day closure. But the most interesting thing happened on the weekly frame. So this is the weekly candles, and what I'd like to say that in order to confirm a reversal, bearish reversal, bears needed to close below this green candle low. And what happened actually? They failed by 2 basis points. And from candles perspective, it is a big failure. And right now, as you can see, the price is sitting right at the 8 EMA and the 8 weekly EMA. And this is a bullish formation right now. Let's see what happens next week. But the chances for a green candle are fairly high, even though we might see a lower low at the beginning of the week, but nevertheless, expect a green candle. The same might happen for the futures. So the candle wasn't sufficient enough by size in order to reverse this formation, and having a strong support at 8 weeks moving average. Now we are looking for higher prices next week. So what is my take on this? I think that at the beginning of the week, based on the daily candles, we might see a lower low, but closer to the middle of the week, there is a chance of reversal and another spike in volatility. Now let's move on to the dollar index. What are the candles telling us? So first of all, I'd like to say that we have a very strong and confirmed double bottom here. So now the chances for dollar to move higher toward this level or toward that level are fairly high. And depending on what kind of candles will be formed in the next couple of days, we might be able to evaluate this potential rally. And I will say that it might be very, very strong. And if we look at our long-term chart, so it remains unchanged for practically 4.5 years, and we are expecting dollar eventually move towards these levels, 120, 112. It might happen this year or in the next couple of years. Nevertheless, this is the long-term perspective. And now I'd like to say something about these candles. So this is our call on March 11, when we said that dollar is about to form a bottom. Whether this is going to be a green path or the blue path, it was not clear at the moment, but we are seeing that the blue path looks like it's taking its place. Now, if we look at the bigger candles, let's say 3-day candle, we were discussing it on a daily basis in our daily market waves report. This is a clear tower ladder bottom formation. This is a posing candle, and now we have a strong bullish engulfing. If we look at the weekly frame, we also have a bullish engulfing there. So what I'd like to say that in the last 3 days, dollar not only formed the bottom, but it also flipped the charts, flipped the daily, 2-day, 3-day, and weekly frames bullish. Now the question is, and all eyes are on the monthly closure. This is the monthly frame, and right now it's still in danger because a closure below 105.42 would mean bearish for long-term dollar. However, if it recovers about 1.25 in the next 6 days, which is very doable considering the bullish engulfing and other strong candles on the shorter frames, I think this is possible. Now let's move on to the next chapter of our discussion is TLT and bond market. We'll start with TLT. This is the chart we've been tracking for a while, since the beginning of March. So far it remains the same. The main message from this chart, Elliott Wave chart, is that the wave that TLT started at the end of January, at the beginning of January, has been corrective. And I'm talking about this wave here. So there is it has much more corrective qualities and the chances of resolving downward one way or the other. There are two paths right now that we are tracking. It's a purple one, potentially an ABC of a bigger B than wave C and eventually a lower low, or a more direct one, the red path, wave 1, 2, 3, 4, and 5, again moving towards a new lower low. Alternative A is still on the table, but in this case the wave would need to form some sort of an ending diagonal here, something like this, and in this case it would make things even worse. So we might see a very sharp and strong reversal. So that's the perspective from Elliott waves. If we look at the candles, as if you watched our daily market update, daily market waves on Thursday after the closure candles, I said that candles were whispering, get out for TLT. And as you can see, we have a very strong confirmation of this Mariposa and belt hold formation. The weekly is still unclear. It's likely neutral for now, but it looks like the bearish odds are building right now. And for the monthly frame, it is so far bearish, and if it closes like this, it will be a fairly strong bearish candle. However, if it recovers, if TLT makes about 2% in the remaining 6 days, well, that's gonna be a reversal, potentially for at least 1 month. Now let's have a look at the yields and see what yields candles are telling us. If we look at the 10, 20, and 30-year yields, what we can see is that on Friday they formed a fairly strong bullish candles, although they haven't confirmed the bottom yet, but the direction is fairly clear. If they continue on at the beginning of next week, it will likely set a very strong momentum. And I would be tracking this one for the 20-year. What I circled here is a potential setup for rising 3 methods, which is an opposite candle formation for falling 3 methods that we often discuss. And if, let's say on Tuesday, if on Monday we see a very strong rally closing above 4.703%, it would be a confirmation of this move, confirmation of rising 3 method. That would be a very strong bearish, very strong bullish formation. Speaking about the 2 and 5-year yields, the candles are somewhat neutral, and there are chances for either path, but we need to see a confirmation. But if we look at the 10, 20, and 30, the chances are better for bulls. Now let's have a look at the spread. Spread right now is concerning at this moment. We discussed it previously that we have a impulse down, we have a very clean corrective wave up, another corrective wave down, and potentially it could be an impulse here. If the spread doesn't make a higher high here and reverses here with a bearish candle, there is a very good chance, there is a very high risk of crossing the zero line. And speaking about the Elliott Wave formation for the bigger chart, this wave is far from being clear. Most likely it is corrective, but we need to see a few next moves in order to determine its true character. Now, if we look at the 20-year yield at the micro level, there is a possibility that it formed an impulse of the bottom, a flat wave for wave 2, and now is looking for the next move higher, which will bring the rates between 4.8 and 5.1 in the next couple of weeks. Well, that would be a very interesting development, and we'll see how it aligns with what the Fed officials are saying. And the final chart that I'd like to show here is our long-term chart, which is based on quarterly candles. And as the quarter is about to end in 9 days, we are tracking its closure right now. So far, the candle is closer to neutral, somewhat bullish, but it will depend on exact level of closure. And right now, it is very vulnerable formation. So if you want to know more about it, just check our website, investingangles.com, for our regular weekly report on the bonds, yields, TLT, and we also discuss Canadian 5-year yields there. Now, let's move on to our commodity section, and we will start with gold. What gold did on Friday, it was an epic failure. It was a confirmation of a bearish reversal on the daily frame. It is still just on the daily frame, but it might become a bigger move if it gets momentum going at the beginning of next week. For that, we have some setup. This is a 2-day frame, which also closed with a bearish Harami formation, but it requires a confirmation in the next couple of days. The weekly so far looks bullish, although we can see a few divergences on multiple indicators, but it's not confirmed yet. Now, if we look at the Elliott Wave formation, this is the chart that we've been tracking for a week. We can see that gold successfully made wave 3 and now is possibly falling for wave 4. However, this wave is not exactly clear, and it still might transform into an impulse, or at least into a diagonal. It would be a very significant development, but we need to see a bigger picture, and for that we need to see a few more days of price moves. Speaking about the bigger picture, this is the wave that gold formed since the middle of November, and we already discussed multiple times. There are multiple concerns about it. First of all, the wave is not entirely impulsive, and there is a chance of forming a non-overlapping ending diagonal. And For this one, the next move would be very crucial. If gold makes a move lower and crosses 2941.3 without making an all-time high first, it would be a very strong failure, potentially leading to the prices to return towards 2541. That's the perspective. And the last one for the gold section, I'd like to discuss the GOD trust candles. So on the daily frame, it is technically a confirmation of top. On the 2-day frame, it's a strong bearish candle. I'd like to see a lower confirmation for this one. The weekly is aligned with the gold, and it's also bullish for now. So that's been gold. Now let's move on to silver. Silver is by far more bearish than gold. It had 3 days of failures, and technically it confirmed a reversal on the daily frame, and it is moving towards making it on the 2-day frame. One more day like this, closure below 32,708, and it will be a strong confirmation. And it all started last week. If you remember this call, this is a statistical call that we issued last week. We are saying that we were saying that silver didn't like the moves above Bollinger Bands on the weekly frame, and based on our statistics, we have a 75% chance of moving lower and forming a red candle. So now we have 100%, and silver formed a dark cloud cover. It's a very strong bearish candle, and if it is confirmed next week, it will most likely be a reversal for the metal. It's difficult to assess how far it would go, but nevertheless, the first step is made. And was interesting to watch how the monthly candle, which was on Wednesday, it was technically bullish and was heading into a bullish continuation candle for the months. Now it is sitting bearish, and with the chances of closing it like this, and the problem would be that the monthly odds would be bearish, somewhat similar to the quarterly ones, which we've been discussed multiple times. Well, all eyes on this formation. Both still have a chance. Speaking about the longer term chart, Elliott Wave chart, we've been tracking it for a while, since the beginning of March, and there are quite a few concerns here. First of all, this wave that started in August has not been corrective for multiple reasons, and at best, if silver is heading for a new higher high, it will make it only as an ending diagonal, somewhat aligned with the green lines here. However, this is a very improbable path. Most likely, silver will take either red or blue one. And in our case, this wave that silver formed since the beginning of March, and it's with the move on Friday, the impulse here was invalidated. So that's a corrective wave right now, and we have a set of corrective waves, which could be a wave B or 2. Let's see where it is, whether it makes another higher high or not. And speaking about the SLV trust, it's bearish on the daily frame. It's almost confirmed a reversal on the 2-day frame, and nevertheless it lost the 8-period support line, and it formed a bearish candle on the weekly frame, somewhat similar to what what silver did. Now this is bearish. So let's leave precious metals for now and let's move into the energies. And we'll start with natural gas. So if we look at the natural gas weekly frame, this is the same type of failure that volatility made, and we just discussed it. So in order to confirm a bearish move, natural gas needed to close just 0.5 basis points lower, but it didn't. And now this candle is treated as an inside candle, potentially leading to a reversal. And now it had a very good support at the 200 days moving average, which is a red line here. If we look at the daily and 2-day frames, they are not super bearish. They are somewhat neutral with these dojis and have a very chances for a reversal. However, we might see a lower low before this happens. And if there is no strong sell-off of natural gas by the end of the month, the monthly closure will likely be bullish. And if we look at the Elliott Wave formation that we've been tracking for a while, so the big one here is the potential impulse, a very small one, and my target is about 3.89, 3.9. Once it hits here, I would expect a reversal of some sort. However, we need to be aware that a closure below even 1 basis point below 3.778 would be a bearish move, and we would need to not only recalculate these waves but also make changes on the midterm frame and long-term frame, which we are discussing regularly in our daily and weekly reports with the subscribers to the energy package. So if you're interested, you can check our website investingangles.com for this particular one. So far, this is our short-term perspective, and let's see how it executes next week. Now let's move on to oil. And what oil did on Friday, it was a very strong failure. Oil had a chance to close above this red line, but it failed and it was pushed down. Now this candle is red, and the same for 2-day frame. This is an inside candle, most likely it will be a reversal one. Speaking about the weekly frame, another attempt for negating this big candle. Oil needed to close about 70.375. However, it didn't, and now this formation is bearish. Speaking about the Elliott Waves, this is the chart that we've been tracking since February 24th and even earlier. Now what is happening right now is oil is forming a big flag. Perhaps it is already complete. We don't know this yet, but I'm not seeing a way how this particular wave, how this flag can be transformed into something impulsive that would drive prices upward. This is my price that have been my target for the flag that have been outlined long ago, and now oil has all chances to reach it in the next 2-3 weeks. Now let's discuss the stock market, and we start with Dow Jones. This is the candle map. What we are seeing here is quite disappointing if you're a bull. On the daily frame, we are seeing technically 4 rejections at the 200 days moving average, and each one of them was failing to form a true bullish candle. So far, the chances for move lower here are significant, and I would like to emphasize here is a 50 over 100 days moving average bearish cross, which stays alive. On the weekly frame, that was a big move by Dow Jones, and what we are seeing here is that after technically forming a double top. Dow Jones tried to challenge the formation and push the price toward the neckline here. However, from the candle's perspective, it needed 41997.92 in order to form a bullish candle. So far, we are seeing that the index failed by 12 points. This could be a very significant signal. So far, this green candle is bearish, and it's called a thrusting line, which has better chances to resolve downwards. And I would like to emphasize a freshly made 8x20 EMA bearish cross on the weekly frame, which also outlines bearish odds. Speaking about the monthly frame here, this is the perspective. So if the Dow Jones Industrial Average closes below the November low, which is outlined here, it will be a strong bearish formation on multiple frames, and it will be a very significant one. So far, it is close. 8 days to go. Now let's have a look at the other aspects. This is Elliott Wave chart that we've been tracking since last week, and what we're seeing here is potentially Dow Jones is forming a corrective wave, which, if it is reversed here, has all chances to move downward and form a very significant impulse. If we look at the bigger frame, this is the all-time chart, and we discussed it in our annual review on January 3rd. So we said that Dow is possibly forming a top here, and indeed the top looks like it's ready to be complete. If Dow Jones forms a very strong bearish candle on the monthly and quarterly frames, this chart would become active. And I would like to say that this is the best case scenario from the Fibonacci and Elliott Wave perspectives. Dow would be looking for 20% loss of the most recent top. And I would like to emphasize this is the best case scenario. Now, once we are looking at the Dow Jones, let's have a look at the Dow Jones Transportation, which always, not always, obviously is an important index, and it's often viewed as a harbinger of the market moves. So far, this is the weekly frame, and we're seeing that the weekly frame closed with a neutral doji, and this is the chart that we've been tracking since when? This is Tesla. This is the chart that we've been tracking since November, technically, when we said that Dow Jones is forming a top. And what is interesting, I also wanted to show you another chart here, which is I already showed. This is Tesla, and I would like to set them one by one so that you can see how clearly the same they are. So this is the bearish formation, and ABC, most likely a flat formation, and the same, a very similar structure of the waves and so on for Tesla. This is we were tracking since November for Dow Jones Transportation, and since the beginning of January for Tesla. Tesla was almost 400 at the time when we identified this target, and you all know how Tesla looks these days. So this is the most recent chart that I have, the March 15th. So Tesla hit our target precisely, and now it looks like it is going for another lower low. But nevertheless, so this is the perspective for Dow Jones Transportation, and we are seeing that it is right now moving strongly down. Most likely that Dow Jones will follow this index too. Now let's move on to the next one in our agenda, and the next one will be Nasdaq. This is the candle's perspective. First of all, I'd like to emphasize this particular formation on the weekly frame. This is the three black crowns that Nasdaq formed 2 weeks ago. From technical perspective and from candlesticks perspective, this is the worst ever formation that Nasdaq did for its entire history. I've never seen this one, and I examined the entire timeline. So this is the worst case scenario. 3 black crowns with a very strong technical and other supports. So how Nasdaq is going to overcome this, I don't know. But so far it is trying. This candle, the previous candle was bearish. This the current candle is somewhat bullish, but it requires a lot of confirmation because technically indicators are not with bulls right now. The daily frame closed with a green candle. However, in light of this red one that Nasdaq formed on Tuesday, it is still bearish, and there is a chance of forming a falling 3 methods here. That's a concern, and the freshly made 50 by 100 days moving average bearish cross is just reinforcing the bearish odds here. The 10-day frame, which closed earlier this week, formed another strong bearish candle, and if in 6 days this candle doesn't become a strong bullish one, we will be looking for a continued move lower. And this is a quarterly frame. So far, this is a very concerning candle, potentially a bearish engulfing. Nasdaq bulls have 9 days to overcome this and say that, well, it's a history. But let's see. So far, the odds are bearish across multiple frames, including the 10 and 15 days, and this is a very strong concern. Now let's have a look at classical patterns. This is the double top that we identified on March 1st, saying that this is the perspective for Nasdaq, and Nasdaq, as you can see, it perfectly hit our target for the double top, and right now it looks like it is forming a bearish flag, because this wave doesn't look impulsive so far, most likely a corrective one. So if this is a bearish flag, then this is a target for this flag, 17.8. I would say, give or take, somewhere between 17 and 18,000. And we remember that sometimes double top can trigger the double distance. In this case, it's going to be around 17.3K. That's the perspective from classical patterns. If we look at the shorter frame, this is Elliott Wave now, what we are seeing here, there are quite a few potential counts here. First of all, I'd like to emphasize that this formation has been corrective, and most likely it might go higher here, but I doubt it's gonna be an impulsive one or a motive one from as I can see right now. So, and while I was thinking about blue count perspective, recent moves and several technical considerations prompt me to think about the potential purple count, and this would be an impulse for the purple count, wave 1, 2, 3, 4, 5 here, which would be either wave A or 1 of a bigger formation. This would be wave B. For this wave B, I would be expecting another higher high here before we look for the next wave downward. That's the perspective on the short term. And if we look at if we zoom out and look for a bigger picture, this is the perspective from Elliott Wave, assuming that the wave that Nasdaq started in October 2022 complete. This would be the most typical retrace for this wave. 17.9 to 15.1K. And the 13K wouldn't be something that very surprises us. Now, that's Nasdaq. You can see that Nasdaq is pretty much aligned with Dow Jones. Let's have a look at SP 500. And we start with comparative analysis of all indices through the lens of ETFs, SPY, Triple Q, DIA, and IWM. What we are seeing here, this is the weekly closure, that technically all indices had fairly good chance to form bullish engulfing at the beginning of the week, but then they gave up and closed the week with bearish continuation candles. And I would like to emphasize that S&P 500 and Nasdaq both lost 50 weeks moving averages. Dow Jones is still holding, and the candle here is somewhat neutral, but we already discussed Dow Jones. It has much better chances to continue lower. IWM, technically this candle is bullish engulfing. However, we will have a special discussion on Russell. So I wouldn't trust this candle too much. I am looking into the index itself. Now let's have a look at the next chart. So this is the S&P 500 roll candle map. So the daily formation is technically neutral. However, I would say it's leaning bearish, because despite the volume and the other technical indicators, so it still cannot lift the price above the 200 days moving average, and even still sitting at the 8 days EMA. So this is a very big concern, especially we have like 5 days of technically the same price. On the weekly frame, we already discussed it. It's a bearish formation, and the freshly made 15 days candle, it's a huge bearish engulfing, which engulfed 7-8 candles altogether. Now the candle that is forming so far, it's most likely it's going to be a consolidation doji, and the next move will be down. And this is a critical closure, the monthly frame. If S&P closes below the January low, it will be bearish. If it closes below the November low, it will be very bearish. So let's see, we know the levels, what to watch on March 31st. Now we look at our technical chart. This is the 10-day MACD, and we are seeing that MACD is technically falling the same way it did in 2022. That's a very good resemblance, and I would like to say that this is also potential for the year 2020, February, March. We have somewhat similar decline here. And the momentum is increasing. If we look at the 15-day frame, it's already across here of a record magnitude, by the way. And if we look at the monthly frame, it is coming. This month or next month, I think it's a done deal. The question is when. Now let's have a look at the sectors. So this is the weekly closure of the sectors, and I would like to say that it's quite a disappointing one. Even though financial formed the green candle, it got a strong rejection at multiple support lines. The same we can say about industrial. Technology is quite disappointing either. So it had very good chance to form a bullish engulfing of this little doji here, but it failed. And that tells me that the bearish pressure is enormous in technology sector. Consumer staples, healthcare, consumer discretionary, and utility all closed with neutral bearish candles. The only one which is bullish is energy. However, I have some doubts that only the energy sector would be able to lift the market when everything else is quite bearish. And if we look at the daily frames, so we are seeing a somewhat similar situation. So it's most likely a consolidation before moving lower. I don't see very strong bullish moves here. And some freshly made signals like consumer staples, for example, formed 50 over 100 days moving average bearish cross, which is rather disappointing for the sector. Well, now let's move on to the big stocks. What we are seeing is some of them closed with green candles. And I would say that only Apple probably has better chances for Monday. Even though the Microsoft and Amazon and Google, they formed bullish candles, they still need confirmations because they failed to close above the high of the previous one. The same for NVIDIA, and Berkshire is clearly bearish on the daily frame. So let's move on to Elliott Waves now. This is the chart that we've been tracking for a month, since February 23rd. This is the perspective. So there are technically two most probable counts on the table right now. One is the blue one with the potential for moving and making a new lower low, which would be a very big impulse. Or this was a corrective wave in ABC, and I'm looking for an ABC correction here for bigger wave B. That the perspective, and from the long-term perspective, this is the chart that we are also tracking since January 11th, technically from our annual report. So it's been unchanged, and we can see that it already hit the best case scenario 5.5490. If it finds support here and moves higher, that could be a wave 4, 3, 4, and 5 somewhere there. But so far, it is yet to be confirmed, because right now we are seeing very strong bearish projections for the end of months, and this could result in very strong bearish candles on the monthly and quarterly frames. So that's the perspective for S&P 500. And now let's move on to Russell. What we are seeing here is clearly bearish. So far, the candles are supporting the move down, and we're on the daily frame, on the 3-day frame, we have a freshly made 50 over 200 days bearish cross, or a death cross. If we look at the weekly frame, the weekly frame is not technically bullish, it's neutral bullish, and it requires strong confirmation. So far there is a chance, but we will be very cautious about it. And the monthly frame right now looks very bearish. And if we try to measure it, let's say this would be something, I would say that Russell would need about 6.2% made in the next 6 trading days in order to flip this candle bullish. It's doable, but I have some questions about it until I can see it. Speaking about the short-term frame, this is the Elliott Wave we have been tracking since February 12th, unchanged by the way. And I'm looking at this as from the perspective of wave 3 of a higher degree. So wave 1, 2, 3, and 4 potentially done. Another lower low would make this wave. Let's see how it plays the next week. And this is our long-term chart that's been also since the beginning of January. this is the target. The question is what kind of count we are having here, whether this is wave 5 that recently completed, and this want to be wave A, B, and C down here, or this is a flat for wave 4. And this was our chart that we are tracking it since the year 2020. And we will talk about it in our Russell update on the weekly report. So that's the perspective for the indices. As you can see, all indices are somewhat aligned for bearish scenarios. Now let's have a look at our special feature of the day, and we will talk about NVIDIA. This is the candles, and I would like to say right up front that we have a 50 over 200 days moving average cross, a death cross for NVIDIA, and it's a fairly rare one. If we look at the weekly frame, last week NVIDIA formed a very nice piercing line. However, there was a concern that it didn't make it to the over 50 weeks moving average, and this was a substantial concern. So now it materialized, and we have a dark cloud cover. Technically, this candle is capping the perspective for bullish continuation. Now we need to see how it is resolved. And the monthly frame is concerning too, very close NVIDIA. If it continues to lose next week and closes below this purple line, it will be a big confirmation of a top. And now if we look at the perspective charts, so this is the one that we discussed way back in December, saying that NVIDIA needs one more higher high, and after that it will be looking for decline. This is exactly what is happening right now, and this wave is developing. I would say that there is a potential for an impulsive structure if NVIDIA makes a wave something like this. But this is a big stretch at this moment, and we need to see how it develops the next couple of weeks. Speaking about technical perspective, this is the chart that we shared at the beginning of February. It's been a scary chart, and what we said that NVIDIA lost its 50 weeks moving average, and it is a significant signal for the stock. Last time it did it in April of year 2022, and after the loss, NVIDIA managed to lose another 53-54% of its capitalization. Now, if we are looking for a repeat of this scenario, NVIDIA would be looking into this level, somewhere here, about 54. Right now, as I'm speaking, it's 117. Well, that's the perspective. This is the technical perspective. Whether it plays or not, we will see. But the perspective needs to be known. And another one that we discussed in December, when NVIDIA made its MACD bearish cross on this frame, and it was the price there. It was 137. This call so far, NVIDIA lost 23% of the top, and the chances, statistical chances, right now, which are on the table, it could be a 50% loss to 80% loss, considering the magnitude and the importance of the signal. Something to keep in mind. And once we are talking about NVIDIA, maybe it makes sense to discuss the TSM company too. What we are seeing so far is that it lost 50 weeks moving average, and these two candles are consolidating ones. It's not a reversal. On the 10-day frame, a very big bearish candle, confirming a top on the 10-day frame, and the next candle was consolidating, dodgy, maybe another one, and this we will look for a move lower. This is the chart that we shared with our subscribers at the end of January, saying that TSM completed an ending diagonal and has much better chances to move lower. And we all know about ending diagonals, that the price tend to return to the level of origin. In our case, it would be 133 with current price of 176, and it would be a loss of about 40% of the most recent top. All right, so this week setups are not just charts, they are signals. At Investing Angles, our unique methodology digs into every candle, every rejection, every cross with unmatched precision. Our mid and long-term forecasts consistently call big moves before they unfold. If you are serious about staying ahead of the curve, smash that like button, share this with fellow traders, and drop your thoughts below. Don't forget to subscribe and turn on notifications so you never miss an update. Want more? Even a free reader subscription gives you access to powerful articles at investingangles.com. And as usual, stay sharp, trade smart, and as always, happy trading.